All right, stocks roared out of the gates for August expiration with a nice gap to the upside today, and it was led higher by these kind of beaten up areas. Small cap stocks, industrials, materials. I'm going to show you those patterns here later. But it's an interesting development to see those areas specifically lead us up. So we're going to talk about what that means, and again, is that a sign of the maturity of the trend we're in? And does that affect our risk reward ratios? And are there any good reward to risk ratios out there that we can trade? With all these areas that have been so strong that are now limiting our reward for the risk we have. So we're gonna break down what the risk is and what the reward opportunities are and where they are. With our trade idea of the day as an example. So let's go ahead and get started. Today is Monday, August the 24th, 2020. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, before we look at some market forecast charts here, I just wanted to take a second and brag about my day that I've had today. So I was off until now. And we took our oldest boy out to the airport so that he could fly off to Omaha, where he'll be spending the next couple of years there, serving the people there in Omaha. And here's our picture dropping him off today. And I have to admit, this was right after both of us said goodbye to each other, and we were crying, and then we're like, maybe we should take a picture. So it was bad timing to take pictures. We were both bawling. But it was also my boy's first full day of school. And my third boy turned 13. So we have our third teenager in our house, with our oldest leaving today, leaving the nest, so to speak. And we have our junior in between. And then our youngest, our little third grader, brings up the rear there at the bottom. So it was a great day for the Settle household. So you didn't hear from me very much, and I didn't do the Market Outlook live, but that's the reason why. And looking forward to what my oldest can learn from the people of Omaha, over Omaha, Nebraska, for the next couple of years. All right, back to the charts. So let's take a look at what's going on here. So you notice that one day after getting a cluster, an overbought cluster, more than 4 months in, we get our annual high, our new 52-week high, our new all-time high on the S&P 500. We just keep now moving this up here, and you can see we finished really darn close to the high of the day there. In fact, if you notice now, the 23% retracement line is now matched up with the 78%. And our 38% is actually now up above the 62. So very, very strong support down here. And even at that level, at the 62. And again, we are moving this line up quickly, but not fast enough to catch up to the 30-day moving average, which means, again, just keep in mind risk reward. I mean, it's great that we move up, 34 points. But just remember that the risk now that we have to qualify is from 34.32 down to 34.31 where we finished, down to 31.39. So it's almost a 300-point drop is our risk, because we can go from 0 to 23 very, very quickly, especially now that 62% line, or that 78% line is sitting on top of it as well. So very, very quick move. It's a very easy, quick move that we can take to get down there. That's the risk. So a 34-point reward with a 300-point risk, you can kind of see when I talk about risk reward, it's great that we can go up a day or two or three, but keep in mind what the risk is for that, and that remains the case. The further we go up, the wider the gap gets from 0 to 23. And no matter how wide it is, it doesn't change the fact that it's very easy to move within that range, even with the 30-day moving average up above that level. And as you'll see here in a minute, the 200-day moving average around and above that level as well. So the momentum line did drop a little bit of a small range, about half of what we are at normal. So and that does not include the gap. So the gap today, we closed at 33.97. The low was at 34.13. So you had about, what, 16 points that we can add to that. So about an average day's range when you include the gap in the middle. But the momentum line doesn't. And because the momentum line doesn't, it brings the momentum line down with such a small range. So the near-term line, though, well back into the upper reversal zone. So nice, good. At least the beginnings of another good near-term rally that may take us all the way to the full 5th month, right? Because we are, it's the 12th. I believe it's the 12th that we need to get to. And the typical near-term rally takes, it looks like the 13th. Is it 13th? Yeah, the 13th is where we got to. So, so we might not quite get to the 5 months on this particular near-term rally, but we'll get pretty darn close, as the typical near-term rally lasts 7 to 12 days. And the bigger the peak like this, especially when we get up at the beginning, the more likely we are to last towards the longer end of that range. Obviously, anything can change, of course, and it's a good sign to see the near-term line getting back above the market sentiment line, and the market sentiment line rising close to being back above 80 again. Also, a little bit of a good sign to see the Dow breaking above its high and pushing back up with a strong near-term bounce. Also up strongly into the reversal zone, and the same thing, of course, with the Nasdaq. Nasdaq didn't actually came down from where it opened, so a little bit of weakness there, but not much. And then, of course, the Russell 2000, which still has not broken up above its high like the Dow did, and still kind of struggling and lagging. And it had a 1% move today, but its near-term line is not above the market sentiment, and its intermediate line continues to move down. So we'll keep our eye on any weakness in the Russell that may, as you can see over here, that kind of showed us the potential for weakness going into that intermediate run. Now, again, just because we might see similar signs of weakness with that divergence move that we had there, doesn't mean that we're going to have a 34% drop in 4 weeks. Right, so it's not gonna doesn't have to look like that, but it does suggest that dang, we can't get the broader market to follow along with the S&P here on such a great day up to new all-time highs, because again, it continues to be these Nasdaq tech names that are showing the strength, and it's not even though the Russell was up more than the Nasdaq, it doesn't have a stronger chart than the Nasdaq quite yet. It will take more days than just one for it to regain that strength. Alright, before we look at some other charts here, I invite you to subscribe to our YouTube channel. Mouse over this icon right here in the bottom right corner of your screen. Hit the red subscribe button that pops out. There's also one down below the video if you're watching us on YouTube. That notifies you when our videos are posted every night. Also, while you're down there, click the thumbs up icon. That tells us 2 things. Number 1, you like our video, and number 2, you want us to do another video tomorrow. If that's the case, if you like our videos and you want to let us know, yeah, you can do that right now with 1 click down there. If you don't like our videos, of course, you don't have to click on anything. Also, while you're down there, comment. What questions or comments you have about anything I talk about? What stood out to you in today's video? Share that with other viewers down below. Follow us on, join our website at marketscholars.com. There's a link popping out there in the top right corner of your screen. Click on that link to subscribe to our site for free. Follow me on Twitter for more content in between the videos from day to day. There's my handle right there at DavidSettle42. And join our Market Outlook Facebook group that we've created. Alright, if you're watching us here on our blog, we also invite you to give us a like here on Twitter and on Facebook. Click this heart right there, opens up this new page. Hit the like button. Also hit this thumbs up. It takes you to your Facebook account. And same thing, hit that like button right there. Again, the more you do those things, it benefits us, because Twitter and Facebook will promote our Market Outlook posts to all of our followers, even if they're not online whenever we post. It also benefits you because they will promote content in your timelines from the accounts that you engage with the most. So we try to make it really easy for you to engage with us here. Also, check out our calendar, our Market Outlook live trader videos on the days I do the Market Outlook, except for today, of course. I do a Market Outlook Live where I review all my old trades that we've done in these videos, and we continue to manage them. We position size, we manage the risk, we go all the way to the time that we close them. So if that interests you, then check out that video as well as all of our trading rooms over here on the right. And there's more. You can see a full calendar worth. Of course, all of our monthly subscribers get access to that. So, if that's something that interests you, you can check out our monthly subscription plan right here, or up here, our Plus plan that you can cancel at any time. You can be able to check out all of our classes. There are 8 different trading rooms week in and week out, as well as you also get access to all of our recordings too, going back. So that's very valuable for a lot of people to be able to go back, especially in Brandon's classes, to see the different ideas that he's had for dividend growth, his DGI, as well as his top down, which you may have noticed that he's talked about here today, the success and track record he's had in that class today. Yeah, here's the tweet I was thinking about there, where some of them are up over 100%, and all 25 of their holdings are profitable right now. So you get access to that class and all the recordings with our monthly subscription. Of course, our premium subscribers get access to all of that too, plus all of our premium tools and content. All right, now let's take a look at the long term, and you can see another really good bullish candle here. A higher close as of now, a higher close in the Hakinyashi candle, a higher high, no lower shadow, about as bullish of a candle as you could possibly get. The Dow looks better, closing above these highs. The NASDAQ, of course, looks great. So far, we're only one day in, of course. And then you can see the Russell, not so good. And it's actually getting even smaller. So just a little bit of concern in terms of like the overall strength. And again, like I said on Friday, if we get an intermediate pullback, that's not going to be the end of the world at all, right? So just keep in mind that like as I talk about any potential weakness on the horizon, that doesn't necessarily mean that we have to bail out of all of our bullish trades. You continue to ride the trend as you have. You just have to be careful about how you manage your risk-reward ratios, as we talked about before. I mentioned the 200-day moving average. There's the 40-week, which is what we use as our proxy for the 200. And you can see it's above the 23%. Let's see here. Let's activate this. Let me sync these drawings here to the high of the day. So give me 1 second. Activate the drawing. There we go. So it's just a little bit below. It's above the 38% retracement, just a little bit below the 23% as of right now because of the movements that we've had on SPX. Remember, the high of the Hakinyashi is the actual high of the week. The top of these shadows. The bottom of the shadows is the low of the week. And you notice some candles don't have shadows because the open is the low of the week never got below the open. As of right now, that's the case for this week on the S&P. Not necessarily the case for the Russell. So the Russell, as of right now, we're fine, but the low is at 1552, and that's only 16 points away, and we had a 16-point move today. So that's very easily obtainable. If we do see that by the end of the week, that will even be more likely that we might be heading into a post-expiration period of weakness. And simply, again, just exhale, not like weakness falling off a cliff weakness, but just exhale. So here's the 3 green arrow chart, and you see we still have the red arrow on the MACD. As bullish as today was, and with the cluster we had on the SPX on Friday, we are easily above the 8-day moving average, and the MACD is almost back up above the moving average, but it's still trading below. And the stochastics, you can see how strongly bullish that is. So remember, we're not worried about even this intermediate pullback until we at least break the 8-day, if not break the 17-day. So keep that in mind too as I talk about signs of weakness, that's the stages. I mean, you have to at least break the 17-day and not get right back above it for us to have any signs at all that we would start this intermediate run that would last for a few weeks to a month or two. All right, so any weakness we get, a lot of it might occur initially as we go from 0 to 23 very quickly, like normal. And we might not go very much further than that. So we can get there very quickly, but I mean, we might stay down there for a week or two, or even longer, up to a month or two, while the intermediate line works its way below 50, and then turns itself back up for a new intermediate run that I very highly expect that we'll get after whatever period of weakness, however it looks like. So while we didn't get a big surge in volume, we did end up getting a gap. So, whether that's a blow, it's very unlikely that's a blow off top gap. And we're not breaking through any significant highs here. So more than likely, we didn't get a surge in volume either, which definitely would have made it either a runaway gap, which occurs at the beginning of intermediate runs, and we've established we are well into one. So it's not a runaway gap. It's not a breakaway gap because we're not breaking through any significant resistance here. We've already gone through those old highs in this area. I mean, this might be a little bit more of a significant resistance, but no surge in volume to help support it. It's just a regular day's worth of volume. So more than likely that's a common gap, which means more than likely that's going to get filled. And again, the 4-week range continues to be pretty wide. In fact, from 343 to essentially 320, you got a 23-point range, well over 5%, which is about 17 points. So well over 5% of that range. So it's a pretty wide range. The point of control is the very top of the value area for the past 4 weeks. So again, filling in that gap and breaking through this 338 and the 335.5 is a level we've talked about before. That's where at least a move to being below the 17-day moving average will occur. But your 8-day moving average is going to be in this area here, so that will be the first thing that happens. And as of right now, we're not even close to doing that. So keep in mind as you anticipate any kind of pullback, it's not going to be the type of pullback that you can trade bearishly. It's going to be the type of pullback that will actually set you up for new trades going forward once we get it. So we can still trade what we got here, just with being aware of the reward risk ratio you have and managing that with trades that won't kill you. You won't be so one-sided if we experience the 300-point risk there is from the 0 to the 23% retracement level. So if you take a look at today's volume here, it was still a little bit below average, and that average is about as low as it's been. And you can see the trading range there at 3.5 points. SPY actually didn't. The low throughout the rest of the day, it actually came in. You can see the low at 339.45, the close there at 339.48. So SPY, if you look at the 1-year chart for it, so here's the 1-year chart. You have to keep in mind that 339 figure, I think, is right. Is that the low point there? That's 340. Where was that 339 low point? Zoom out here. It was over here in this area. It was kind of closer to the open of the day. So keep that in mind about SPY. Is when you're not looking at when you're looking at the full extended hours trading, it didn't have a gap as the gap occurred actually throughout the extended trading hour session. And then you can see throughout the rest of the day, I mean, that's all the move that we got throughout the rest of the day. We finished a little bit high. We were down from the open and then finished a little bit higher than the open with this kind of late end of day surge. And we're actually up a little bit more today, up to 343 in the after hours so far as I make this video here. So, keep that in mind that here is the ATR. Look how close we are to breaking the 1% level. And again, if we do break it, I don't expect we'll break it on this first go around very much. It's very likely that we will instead bounce off to maybe 1.5%, if not 2%. But as of right now, again, another sign that weakness will start will be when we start getting ranges that are well above 1%, like up to closer to 2%. So that's looking at 6-point moves or 5, 6, maybe 7 or 8-point moves, and obviously and also bigger moves here. right, where we start getting, bigger, more than 1%, close to 2% rallies. You can see as we were heading towards the COVID moves, we were getting bigger than 1% drops on that divergent move, that high point that we had. So we are starting to get, after really a few months of not getting any kind of significant move up or down, we started to get bigger moves, and bigger than 1% to the downside, and that was our sign that more of an intermediate pullback was coming. And also, too, the thing that's standing out is that volatility is not dropping towards historical volatility. These two have to reconcile one way or the other. Either implied volatility will drop or historical volatility will jump. And it's hard right now for implied volatility to drop because on a relative basis, it's already extremely low. So for it to go down further, it needs to get up here and then work our way back down with the VIX dropping more on the way back down. So it's fine. It's having a hard time dropping because it's already, getting below 80% is an extreme level. And we've been below there for now, a couple of weeks. So again, another sign that we're just kind of watching for this, this exhaustion point on the current intermediate run, not on any long-term trend. Again, any pullback we get, it's not going to be a pullback that we would like trade bearishly. It would be one that we would watch for actually opportunities to enter new directional bullish trades that will have much better reward risk. In the meantime, we make bullish trades, but just less directional bullish trades that we can manage the risk better with than we can with our more directional speculative type moves that we typically do when we expect to have a good reward for the risk that we're taking. So that was a pretty good summary of what my technical outlook is. Very strong trend that persists and looks like the beginnings of a new near-term run that we don't know how long it lasts. And it has a pretty good chance because of the start here that it could last for a good 7-12 days, which is its typical range, which would take us into a very long 5-month intermediate rally. But again, there's signs of weakness still continuing to crop up, and we just be aware of those signs and recognize the risk for the rewards that we're trying to take right now on any new trades, and knowing that ratio will move favorably in our direction if and when we do get more of an intermediate pullback, where that intermediate line falls back down below 50. And when it does happen, it won't be a bad thing. It would actually be a great thing, something that we anticipate and will look forward to because of the opportunities it will afford if and when it does happen. The problem will be the longer we go without one, the bigger it will be. Not the bigger percentage-wise, because, again, more than likely, we could very well just fall 23% and be done. So percentage-wise will be the same, but the move to 23%, especially the move to 38%, which is where there's going to be very strong support, is going to be very uncomfortable for people that have blinders on to the size of the rally that we've had that preceded it. So we always think in terms of what have you done lately, and a 15% drop is a big deal when you're not thinking of the 50-some-odd% rally that preceded it. So what do you think? Do you agree with that technical outlook? Do you disagree? Let me know in the comment section below, especially if you disagree. Let me know why you are either more bullish or more bearish than I am, especially with the evidence of that drives that opinion. What charts or indicators are you showing or looking at that suggest that? And share those in our comment section down below. All right, now let's take a look at what's driving this price action today. So let me just pull up a comparison chart, and you can see the strength in emerging markets and the strength in the Qs continuing to be a main driver just visually on that chart. Let me show you just today's alone. There you can see international stocks did very well today, even with the dollar doing okay, and SPY, doing kind of matching IWM throughout the day. And the Qs, at one point, the Qs were close to being negative. In fact, they were slightly negative over here. On the other hand, look at the safety trade. Bonds down today with yields up a little bit, and gold down with the strength in the dollar. So, again, strength in the dollar as we continue higher is not going to be a bullish thing. So just remember that as we get continued strength, that will most likely coincide with weakness in risk appetite. And as of right now, we do have light pink shading, and the intermediate line has fallen below market sentiment. So does that mean that this is starting now? Who knows? The near-term line did not get into the reversal zone here like it did on this low point, so it is a higher low. It is a higher low in the chart, so we might get another high here, another bounce, maybe even kind of a head and shoulders type bounce on this next near-term run in risk appetite before things finally turn around. Let's take a look at the yields, which had a positive day again today after a little bit of a pullback. And so again, we might get a little bit of a bounce here back up towards 70 basis points before things turn. We are still light pink shading here as well on this, like I said, next current near-term rally and risk appetite as a whole. If you take a look at gold prices, it's given us that classic light pink shading and yellow line pattern. It's been doing it for today's for the last couple of days. It's been giving us that pattern, and there you can see it's closing below, barely closing below on Friday, but or closing below yesterday. Excuse me. This is today's candle so far, closing below. So yesterday, the first day that we finally got the light pink shading and the yellow line, but even if it's just barely. That's typically a bullish pattern, so we'll see if, especially right at the 38% retracement level at support, very good opportunity that gold can bounce off of that level. Crude oil continues just to be as flat as it can be. It's not really moving much of anywhere. In fact, if you look at its Bollinger bandwidth here, it's all the way down to practically nothing. Very, very small compared to where it's been in the past. Very tight range it's been trading in, building up a relatively bigger size of volume node here at the bottom of the value area. So remember, when you're in the value area, the point of control acts as a gravity. So more than likely, it's if and when we get a breakout move in crude, it will be back up towards 55 and up into that area. Just it's a lagging asset class, so as stocks have really made their own run, you'd expect this to make its own run after the fact. All right, let's take a look at how sectors performed here, and we'll take a look at their chart. And again, just looking at today alone, so give me 1 second here to pull up today's move, and we'll look at it on a 10-minute chart. Interesting to see, again, this kind of this is that rotation trade that we saw before that has had some spurts of greatness, so to speak, during this intermediate run we've been on, where industrials and financials and materials and energy all lead the way higher, and your cyclical areas, your tech, QQQ, all kind of lag behind, and there's your safe havens. Safe havens are up today, so it wasn't completely risk off in that regard. In fact, the only sector that had any significant move at all to the downside, an outlier outside of real estate, was healthcare. So it's interesting, a little buy the rumor, sell the news type event there. But there's our cyclical trade, and as we saw on June 8th, that's the run. Those sectors did very well heading into that June 8th high point. So whenever I see any sustained outperformance in those areas above and beyond, especially if these other areas lag, again, I go back just to kind of show you, going back to where was that? It was here. Let me go market forecast. It was right about here in this spot. So from May 13th, May 14th, all the way up to June the 8th. So if I go back to the sector rotation and go to May 14th to June the 8th, that was the time frame that this rotation made such a strong run. There's your energy, industrials, and financials and materials all outpacing, and consumer discretionary did okay, but not technology and communication services, which is really, discretionary has Amazon, And now all the other FANG names and other large cap tech names in the NASDAQ 100 that are killing it are all in these two sectors. So, as bullish as we were there, when those sectors underperformed during that bullishness, as we saw with June 8th, that opened up a period of weakness there. That then brought us to the 23% retracement level after that period. And in a matter of 3 days got us there. Remember, a move to the 23% retracement level will be a lot more significant because this time it would get us well below the 30-day moving average, whereas this time it only got us to the 30-day moving average. All right, so for our trade idea of the day, I wanted to take a look at one of the stocks that's in that kind of beaten up rotation, that sectors of the market that had a good day today. And one of those stocks in the industrials areas is Southwest Airlines, the airliners. Has had fits and starts. Like I said, from that May 14th, there's the May 14th to June 8th. And you can see the kind of rally you had there during the period where that's the areas that led. We're getting another period of pretty good strength here. We've had, the beginnings of an intermediate run. It had its own intermediate pullback. It's got the beginnings of an intermediate run with a strong near-term peak, higher peak here, and then a higher low point. And now looks like a little bit of a breakout to what may be a new higher near-term high. As you look at like the 3 green arrow charts, you are easily above the 8-day moving average. You can see the crossover that occurred earlier. We had a little bit of a convergence first and now bouncing back up. All these other oscillators showing very good signs here. The RSI breaking above 60. The CCI had broken above 200 initially on the beginning of this intermediate run, which is a very good sign. The DMI is showing some positive patterns too, above 30, well above 30 on the positive index and below 20 on the negative. The ADX is rising as a result, and now it's close to rising above 20. Getting the start of a light green shading until it crosses above 25 and starts the dark green shading there. You can see from an Ichimoku cloud, you can see we had come back into the cloud. We broke back above the green line, back out of the cloud, and maybe the beginnings of after a really noisy period here, the beginnings of a bullish trend. Especially with that ADX rising as it is. And the other positive development here is the Bollinger Bands are breaking out above the point of control, pushing the upper band back up here. And you can see where the top of the value area is and what kind of move it can make. If it gets into this gap, again, you can see why it made such a big move here. There wasn't nearly as much volume in this area back then. So it was able to really move quickly through what was more of a volume gap at the time. Now that we've built up a lot of volume here and we're above that, there's a lot of support below you, so low risk, and a lot of space up above you, which is pretty decent reward. So going to October expiration, where 1 standard deviation right now is setting up for $45, we can say, okay, how about if we bought the 42.5 and sold the 45? So pretty aggressive, but is able to keep our risk really, really low here. We'll keep it to half of what our normal risk is because of the directional nature of the trade and the likelihood. In fact, we'll probably dial it back a little bit. The likelihood that we can, we might not get out at full max without a full max loss because of the wider spreads between the bid and the ask. But you can see for a few $100 of risk, over $1,600 of reward potential depending upon where we get filled in at by tomorrow. So again, not a lot of good risk-reward ratios out there right now because of how bullish we have been, except for in areas like this, which is playing catch-up and the potential of the catch-up trade working out again here. All right, so that does it for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forums on our website at marketscholars.com. Open up any new thread with any new questions or comments you have. Apply to other people's threads as well, and let's keep this conversation going in between videos. You can also comment on our Twitter, on the Market Outlook Twitter post. You can also comment on our Facebook post too. And like I said, let's keep this conversation going before tomorrow's video. As always, thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon on the YouTube video as well as on Twitter and Facebook, and comment on our video. Join our website at Market Scholars with that link that I showed you before, and our Facebook group that we've created. Have a great rest of your evening, everybody, and we'll see you all next time.